On paper, assuming a seller's mortgage sounds amazing. A lower interest rate, a simpler loan, maybe even lower closing costs. But here's the truth. Assumable mortgages almost never work in real-world Kentucky transactions. Let me break down exactly why. Welcome to this video on assumable mortgage loans in Kentucky. We'll explore the truth behind this trend, why buyers are asking about them, and why they rarely work in the current market. First, let's cover the basics. Loan assumption means the buyer takes over the seller's existing loan terms, including the interest rate, remaining balance, and loan term, instead of obtaining a new mortgage. Generally, FHA, VA, and USDA loans are eligible for assumption, but conventional loans are not. Buyers are interested because of, quote, rate envy, seeking historical low rates, lower closing costs, and the perceived simplicity of taking over an existing loan. On paper, it looks like a financial home run, but in reality, it's much harder to achieve. The number one deal killer is the, quote, equity gap problem. You assume the remaining balance, not the purchase price. For example, on a $300,000 home with a $180,000 loan balance, the buyer must bring the $120,000 gap in cash at closing. Second mortgages to cover this gap are rarely allowed. Assumptions require significant red tape. Lender approval is mandatory, and banks often have no incentive to allow the transfer of a low-rate loan, leading to delays or denials. Full underwriting, including credit checks and income verification, is required, and the timeline can be 60 to 120 days, much longer than a new loan. Sellers often say no due to liability issues. They may remain liable if the buyer defaults, a massive financial risk. For VA loans, if a non-veteran assumes the loan, the veteran's entitlement remains tied up, limiting their ability to use their benefit for a future home. These high risks deter most sellers. Assumptions are, quote, unicorn scenarios, working only when the seller has minimal equity. The buyer is cash-heavy, it's a family transfer, or the buyer is willing to wait months. For 95% of Kentucky buyers, these specific conditions do not exist. In summary, assumable loans have high cash requirements, long delays, and seller liability. A new mortgage offers flexible down payments, assistance options, fast closing times, and a clean title. Our advice: don't chase the rate. Buy the home with a loan that fits your budget. Thinking about buying a home in Kentucky? I help first-time buyers compare FHA, VA, USDA, KHC, and conventional options, including whether an assumable mortgage is even realistic for your situation. Call/text 502-905-3708.